So many of you had questions about the Inflation Reduction Act of 2022 and what it does to EV tax credits that I decided to make a second video to focus on some of your questions and perhaps present the information in a slightly different way and include a few updates. So don't worry, this is not the same video that you saw on the other channel. Let's just dive right on in. The first thing to know is that all EV credits and plug-in hybrid credits are now $7,500. Previously, it was based on the battery size, and that meant on some plug-in hybrids, the max credit was not $7,500, it was lower. Now it's all $7,500. But the list of available vehicles has been reduced quite considerably. Currently, they have to be made in North America. That means that the EV has to be made in Canada, the United States, or in Mexico. This is the current list of EVs that will qualify for the credit from now through the end of calendar year 2022. We have the Lightning, the Mach-E, the E-Transit van, the Mercedes-Benz EQS SUV when that comes on sale a little bit later this year, not the sedan, just the SUV, the Lucid Air, the Leaf, the Rivian R1T, R1S, the electric delivery van, and likely the very few number of Volkswagen ID4s that are going to be built in Tennessee. On the plug-in hybrid front, we have a list about the same size. The Audi Q5, the 330e, the X5, the Pacifica, the Escape, Grand Cherokee, Wrangler, Aviator, Corsair, and the Volvo S60. Those are the only plug-in hybrids that qualify because all of the other plug-in hybrids or EVs are built outside of North America. A lot of folks had questions about the Hyundai and Kia plug-in hybrids. Yes, the regular models and some of the hybrids are built in the US, but the plug-in hybrid variants of those vehicles, those are built in South Korea, and that's why they're not on this list. The key thing here is that the price cap does not take effect just yet. So let's just go in calendar order. That's what's going to qualify for the credit right now through the end of calendar year 2022. $7,500 max tax credit on these vehicles. I'll talk more about the tax implications later in this video. Starting January 1st, 2023, the rules will change again, and then the rules will continue changing every January for a few years. Let's go in order. January 1st, 23, General Motors and Tesla regain their eligibility for tax credits. That means that ostensibly EVs that meet the requirements made by those companies will get the $7,500 credit. And here's where the requirements come in. So $55,000 maximum price tag on a sedan, $80,000 maximum price tag on an SUV, a van, or a pickup truck. These are key because the base Model 3 theoretically could qualify if it passes the rest of the testing regime. All of the Model Y models, they appear to be in the game, but the Model S and the Model X are too expensive unless we see a cheaper version of those vehicles from Tesla. Currently, the Cadillac Lyriq should be just fine because it's an SUV. The Bolt and the Bolt EUV, they should be fine as well. But the Hummer truck and Hummer SUV, they're too expensive. They're over the cap, as would be the new Cadillac Celestiq. Now, the upcoming Blazer and other EVs, they will probably qualify as well, as will Honda's new EVs, because they're going to be built by General Motors in North America. So whenever they come out, probably sometime in 2023, they should be okay. Now, in addition to those price caps, we have some battery sourcing and mineral sourcing requirements that come into effect January 1st of 23. 50% of the battery components must be made in the United States or in Canada or Mexico or the list of free trade countries that the United States has free trade agreements with. These include a number of countries in South America, also key Australia and South Korea, but not importantly China or some of the other countries where a large percentage of battery components are currently made. So production is going to have to move to some of those free trade countries. Also, 40% of the critical battery minerals must come from this same list. If you are under those requirements, then no credit applies. This is really going to be critical for the least expensive version of the Tesla Model 3. It may or may not qualify depending on where the sourcing of these materials comes from. Currently, the base version of the Model 3 uses a Chinese-made lithium iron phosphate battery pack, whether or not Tesla swaps in a different pack, or whether or not that pack could qualify based on sourcing of materials is honestly unclear at this point. We will have to wait for further guidance. Another big change starting in January is going to be income testing. You will have to have an adjusted gross income of under $150,000 filing singly, $225,000 filing head of household, or $300,000 filing jointly. Remember, this is adjusted gross income, not actual gross income, not the total on your paycheck. I'll talk more about that towards the end of the episode, but that is a critical thing to keep in mind. The other thing that you should know is that binding contracts will help you jump over the bridge on any of these changes in legislation. So if you were fortunate enough to have a binding contract, which meant a non-refundable deposit that fulfilled the rules in your state about binding contracts, if you had one of those before August 16th, then you can take delivery after August 16th, still get the old credit scheme. If you have a binding contract before December 31st this year, then you can take delivery after that in 2023 and still get the tax credit scheme that existed prior to that. But any way you slice it, all the EVs and plug-in hybrids sold by Kia, Hyundai, Genesis, Porsche, Jaguar, Polestar, etc. currently are all out in the cold, and there doesn't seem to be any resurrection of those credits unless those manufacturers change something about their production process. Now, the other thing to know is that the rulemaking process is not complete. As often happens, the law is passed, then the rulemaking process must happen, so some of these details may massage around a little bit, and it's always possible that there could be some variations to some of these requirements at some point in time. The next date that you need to keep in mind is January 1st, 2024. On that date, the battery sourcing requirements jump up to 60% of battery components, 50% of critical materials. Also, starting in 2024, you will be able to use your tax credit as a point of sale credit to reduce the purchase price of your EV. Remember that up till this point, it's a tax credit. So you buy your EV, you do whatever that is, then you get a tax credit on your taxes. It doesn't come off the purchase price. Starting in 2024, you will have the option to make it come off the purchase price. Exactly how that works, we don't know yet, but it does appear to be optional. It's not like you have to do that. You will be able to still apply for the tax credit on your taxes because not all dealers may accept the credit. Exactly how that works, again, is a little bit unclear, but this would reduce the amount financed. The next thing that happens in 2024 is that the used EV tax credit scheme comes into effect. Lots of rules around this one. The used EV must be at least 2 years old or older. It has to be under $24,000, so no lightly loved Porsche Taycans or anything. There are no sourcing requirements on used EVs. So if your new EV did not qualify for the tax credit, once it is 2 years old, it may actually qualify for the used EV tax credit. But more complications lie here as well. The credit maxes out at $4,000 or 30% of the value, whichever is less. It must be purchased from a dealer, so no private transactions will qualify here. And the used EV may only ever get a tax credit once. So the third time it is sold or the fourth time it is sold, it will not get another tax credit. And more importantly and more strangely, the buyer will have to wait 3 years until they can get another used EV tax credit. Also, income testing applies here. $75,000 AGI maximum for single filers, $112,500 for head of household, $150,000 AGIs for joint filers. Starting January 1st, 2025, there's an additional ratcheting up of those requirements for battery components and sourcing, 70% of battery components, 60% of critical materials, and more importantly, none of the minerals for the battery can come from countries of particular concern as defined by the U.S. State Department. That would include Myanmar, China, Iran, North Korea, Pakistan, Russia, Saudi Arabia, Tajikistan, and Turkmenistan. China is the big problem here because China is where a lot of rare earth materials are sourced. Now, Australia is, for most of those materials, either the second or third largest producer in the world, but a decent distance down, and a lot of those materials are processed in China. So this means that it is possible to probably move production around, but it also means that any of those Chinese-made battery packs are all of a sudden really going to be out in the cold, even if their minerals and some of the battery components otherwise met the legislative requirements. Zero content on the mineral side may come from China. After this point, no substantive change in the legislation happens every January except for the continual ratchet up of the battery sourcing requirements and mineral sourcing requirements until battery content hits 100% and the raw mineral content reaches 80%. Then in 2032, the entire law actually cancels out, until it's replaced by something else. Now on to the question and answer section here. A lot of folks had a number of questions about how batteries are sourced and do we know exactly which models will be in and which will be out. The easy answer here is no. I don't have a crystal ball and manufacturers generally don't disclose that kind of content on the batteries, but they will need to do it shortly. Of specific concern are going to be the less expensive Tesla models, which we know have moved to LFP batteries made in China. Clearly here, it's pretty easy for Tesla to swap in a Panasonic battery because they have Panasonic batteries on their other vehicles. As long as those batteries are made in North America and their content comes appropriately from the countries on that list of approved countries, then those should be just fine. And I would expect Tesla to make those kinds of changes. I wouldn't be surprised if they simply stopped using the LFP battery in the base models. Now, the next question that a lot of folks had was about the income caps and the prices. They do not adjust with inflation. So from now through the end of 2032, the income caps remain the same. The price caps on the EVs remain the same. And that means that it is likely that the number of vehicles eligible for these is going to gradually decrease over time as costs ramp up. So the Model 3 keeps getting more and more expensive. It's entirely plausible, but by the time 2032 rolls around, that Tesla simply does not have an inexpensive EV that may qualify unless they create new models, which is always possible. 2032 is a pretty long way away. The next thing is about binding contracts. Lots of questions about this. So you have to enter into a contract with your dealer. This would be the dealer, not the manufacturer of the car, unless they're one and the same, as they are with Rivian and Tesla, for instance. Generally speaking, a non-refundable deposit has to be put down. The IRS has some rules around this. They say a non-binding contract, generally speaking, includes a 5% non-refundable deposit. But in reality, when I've talked to other sources, it's going to depend on state law in your area. So in some places like California, it appears that several $100s of non-refundable deposit and the appropriate contract could qualify for this section as well. And a lot of folks out there that have Rivians, for instance, Rivian has just converted the $1,000 refundable deposit into a non-refundable deposit, and that appears to qualify. Lots of folks had questions about the income testing limits. Key thing here is this is adjusted gross income, or AGI, not how much you made, quote unquote. So generally, when we talk about salary in America, we're talking about that top line number. I made $200,000, I made $300,000 this year, so I wouldn't qualify for the tax credit. Well, it's actually more nuanced than that. AGI is after all of your deductions. So after student loan interest, alimony payments, contributions to tax-deferred retirement accounts as well, whole host of other things. As always, consult a tax professional. I'm not a tax attorney, but I do my own taxes every year, and I do my corporate taxes as well, generally speaking. So I'm a little bit more versed on this, but I'm not a tax professional. Get appropriate consultation on there. The next question lots of you had was, is the tax credit for new EVs refundable or non-refundable? The answer is non-refundable. What's the difference? A refundable tax credit is like the child tax credit. You get the money back from the IRS even if you owe no federal taxes. A non-refundable tax credit means that you must have a minimum federal tax liability to get any portion of the credit. And the credit is capped at either the maximum of the credit or the maximum of your federal tax liability. So if you're filing your taxes at the end of the year and it says, this is how much federal tax you have paid the government, this is how much total taxation you have, if that number is under $7,500, you could get all of it back up to the maximum that you actually owe the federal government. This has no bearing on what you've paid so far as estimated tax payments or payroll deducted tax payments. That's not consequential. What's consequential is that actual value at the end of the year on your filing. So whether you've underpaid or overpaid the IRS through the year does not matter. It's just how much tax theoretically should you be paying the IRS for this tax year? Is it over $7,500? If yes, you get the full credit. If no, then it's capped at whatever that number may be. Of course, plus all those other deductions that you might have. Next up, leasing seems to be something that is complicated and a lot of people don't quite understand. Leases are generally going to be unaffected because leases never got you the federal tax credit. Here's what's going on. When you lease a vehicle, the vehicle is owned by the leasing company. That may be the captive finance arm of a car company, say Ford Motor Credit, or it could be a third-party bank like your local credit union or oddly enough, like Stellantis' credit department, Chrysler Capital in North America. Stellantis, the global conglomerate that owns Chrysler and all of its affiliated entities, does not actually have a captive finance arm. So all of that being run through Chrysler Capital is actually done by Santander Bank. Now, whether or not the tax credit in the end will affect the value of that lease depends on a wide variety of factors. The most important of which is, does that finance company actually pay any taxes? That's a big question because, for instance, the Volkswagen Group, with a captive finance arm, has not made a tax profit in about 9 of the last 10 years. So if Volkswagen was to give you that tax credit on your lease, basically they're subsidizing the lease. So this is a weird construct. Some car companies and some dealers may say, we're going to apply the value of this tax credit to your lease. But that is absolutely not what is happening, because whether or not the company in the end ever gets that tax credit, no one really knows until the end of the tax year. But what we do know is that some car companies will incentivize the lease by that number, and you've essentially created the same thing. But semantics-wise here, it's not actually applying the tax credit to your lease. This is really one of those areas where we just have to wait to see how the chips fall. But it is worth knowing that a number of car companies have already really pushed aside traditional leases for electric vehicles because of the tax reality of this situation. Customers expect that lease to somehow reduce the cap cost, even though it generally won't. And that's why Ford really doesn't do traditional leasing on the Lightning or on the Mach-E. Instead, Ford has been doing balloon payments with guaranteed buybacks, which is what we tried when we had our Mustang Mach-E. The deal looks more like a finance arrangement because the vehicle is titled in your name. You have bought the vehicle from Ford. But what you're doing is you're only paying a portion of the payments. And then after 3 years, there's a balloon payment if you want to keep the car, or Ford will guarantee to buy it back for that balloon payment amount. Obviously, with some deductions based around the condition and quality of the vehicle after the end of that term. But plans like that are likely going to be more popular as we go forward because of the realities around how the tax credit works with leasing. The key thing to remember here is that even though a business may be profitable in year A, B, or C, it may have actually posted a tax loss all 3 of those years based on other business activities that will change their actual tax liability with the federal government. So it's entirely possible for a company to be profitable, but not profitable as far as the IRS is concerned. So tax losses, actual losses, not the same thing. And the business would need to have actual tax profit in order to take advantage of these EV tax credits that they have acquired. Because again, they're buying the EV, they get the tax credit, they then basically rent the car out to you. You don't get the tax credit, they do, if their tax situation applies. Anyway, hopefully that has answered lots of your questions. If you have any more, you can always pop them down there in the comment section. Hopefully we'll get to them, and if there are enough of the same kind of question, then I will try and do another video. In the meantime, hit the subscribe button. Be sure and subscribe to Alex and Autos as well. Find me over at Facebook, Instagram, Twitter, all of those social places, and I'll see you later.